everyone, and welcome back to the Deep Dive. Today, we're going to really dig into some interesting stuff, the preliminary results Tesco PLC just released for their fiscal year 2024-25. That's the year ending February 22nd, 2025, just to be super clear.
Yeah, if you're looking to get up to speed quickly on Tesco, you're in the right place. We've sifted through their quite extensive press release that's our main source today, and we're going to break down the really important stuff. So you can get a handle on Tesco's performance without getting lost in the weeds.
Exactly. So think of this as your clear and concise cheat sheet to Tesco's recent performance and their, future outlook. Let's jump right in. Let's start with those financial highlights, shall we? Because I gotta say, there's some pretty strong performance to talk about here. They hit $63,636 million in group sales, excluding VAT and fuel. That's a 3.5% increase.
Yeah, and if you factor in the currency fluctuations, it gets even better, 4.0% at constant rates.
Okay, so that's a good start. What about profitability?
Well, they saw a pretty significant jump in their group-adjusted operating profit. That landed at £3,128 million, up 10.6%. Again, at constant rates, it's even a bit higher, 10.9%.
So double-digit growth. That's not too shabby at all.
No, not at all. And their retail-adjusted operating profit also showed a notable increase to $2,973 million, marking a 7.7% rise, or 8.1% at those constant rates we keep mentioning. And just to add to this positive picture, they generated a healthy $1,750 million in free cash flow.
Okay, now that free cash flow figure, I always think that's one of those numbers that really tells a story about, the underlying health of a business.
Absolutely. Shows how much cash they have left over after covering all their essential investments. So, yeah, definitely a good sign.
What else jumps out at you from these sort of high-level figures?
Well, they've done a good job of reducing their net debt down to $9,454 million. That's a positive move. Generally, it suggests they're on a more solid financial footing.
Oh, yeah. Makes sense.
Then you've got adjusted diluted earnings per share. Now, for folks who might not live and breathe finance, that's basically the profit allocated to each outstanding share after some adjustments, of course. That figure saw a substantial increase to 27.38 pence, so a 17.0% growth.
Okay, so good news for investors.
Yeah, and for investors who like those dividends, theirs went up too, increased to 13.70 pence per share, a rise of 13.2%. So, when you put it all together, these core numbers, they're definitely painting a largely positive picture.
It's interesting to see how these results are framed in the report too, right? Like what Ken Murphy, Tesco's CEO, is choosing to highlight.
Oh, absolutely. The messaging is key. He's really emphasizing their commitment to offering both value and quality to shoppers, making sure products are available on the shelves, and highlighting the fact that they've reached their highest market share in nearly a decade.
So it's not just about keeping up, it's about taking the lead.
Exactly. He specifically mentioned their investments in competitive pricing and innovation, over 1,600 new or improved products. And just caught my eye, they launched 400 new items in their finest range, the premium stuff. And that saw a pretty remarkable 15% increase in sales.
Oh, wow.
Yeah, so that really tells you something about where they're seeing strong customer demand, not just value, but quality too.
And it sounds like they're not just focused on what's working right now. They're looking ahead, right? Thinking about where they want to be in the future.
Absolutely. The report highlights significant progress in a few key areas they see as crucial for long-term growth, like further developing their digital capabilities, making online shopping even better.
Yeah, make it as frictionless as possible.
Right. And they're also expanding their retail media offering, basically their advertising arm.
Yeah.
That's becoming a bigger and bigger revenue stream for a lot of retailers these days.
It's always good to see companies recognizing the people who make it all happen too, right? The employees.
Absolutely. Crucial. They specifically acknowledged the hard work of their 340,000 colleagues and highlighted their investments in employee benefits. They put in over $900 million in pay increases over the last 3 years.
That's not insignificant.
No, not at all. That kind of investment in your workforce, it can really make a difference in morale, and ultimately it affects the service that you and I experience as customers.
So big picture, it sounds like Tesco is feeling pretty good about their position moving forward, even with all the, economic challenges everyone's talking about.
Yeah, they're definitely striking a confident tone. They're highlighting their robust financial performance, their healthy balance sheet, and the positive momentum they've built. All of that, they say, is setting them up well for the year ahead. But they're not ignoring those inflationary pressures, of course. They know those headwinds are still out there. Their focus on providing value to customers and strengthening their position in the market Those themes run throughout the report.
Okay, let's roll up our sleeves and dig a little deeper into some of these areas. Let's start with sales and profitability. We've seen the positive overall numbers, but what about the breakdown of that like-for-like sales growth?
Good point. It's always worth looking under the hood. So like-for-like sales, or LFL, it's a way to compare sales in stores that have been open for a certain period, excluding new openings or closures to see how they're doing year over year.
So it gives you a cleaner picture of how the existing business is actually performing.
Exactly. At the group level, their LFL sales were up 3.1%. But, as you might expect, there's some variation across their different markets. The UK had a solid 4.0% increase, and the Republic of Ireland did even better, 4.6%. Central Europe also contributed positively with a 2.2% rise.
Okay, so all good so far. What about Booker?
Well, Booker, their wholesale division, they actually experienced a slight dip of 1.8%.
Interesting. They gave some reasons for that in the report, right?
They did. They pointed to a continued trend of decline in the tobacco market, which, makes sense given all the health concerns and regulations.
Yeah.
That has a big impact on Booker's wholesale business. And they also saw lower volumes for Best Food Logistics. They're part of the business that supplies the fast food industry. So those factors outweighed the growth they saw in Booker's core retail and catering segments. It's a mixed bag there for sure.
Okay, so let's shift back to profitability for a second. The UK and Republic of Ireland, they both saw a decent increase in adjusted operating profit. I think it was over 10%.
Yeah, 10.3% to be exact. And that was driven by a couple of things. First, good old-fashioned increased sales, strong volume performance, they call it. Basically, they sold more stuff.
Always a good strategy.
Right. And then their ongoing Save to Invest program also played a role.
Remind us again what that program's all about.
So Save to Invest is their ongoing initiative
Mhm.
to find efficiencies and cut costs across the business, streamlining operations, all that good stuff. And it seems to be paying off. They're also getting a boost from their Insurance and Money Services, or IMS division. That contributed $155 million to the UK and Ireland segment's profit.
Okay, that's significant.
It is. But, and this is an important note, $46 million of that IMS profit was non-recurring. It was a one-off benefit, largely due to a new 5-year pet insurance contract they signed. So while the overall profit growth is strong, we have to remember that a chunk of it won't repeat next year.
Okay, good to know. Always got to look at those underlying trends. Now, Central Europe, their adjusted operating profit growth was even more impressive, wasn't it?
Yeah, Central Europe was a star performer. 28.9% increase in adjusted operating profit.
Wow. What drove that?
Well, a few factors combined to create that very positive result. They saw an improved product mix. Basically, they sold more of the higher margin items. They also had volume growth, similar to what we saw in the UK and Ireland. And just like in the other regions, their Save to Invest program is also delivering results in Central Europe. So, yeah, a lot of positive momentum there.
Now, we talked about that 17.0% growth in adjusted diluted EPS earlier, and we mentioned that their share buyback program plays a role there. For those who might not be, financial experts, can you quickly explain what a share buyback is and how it affects that EPS number?
Sure. So a share buyback is basically when a company goes out and uses its own funds to buy back some of its own shares from the market.
So they're essentially investing in themselves.
Exactly. And by doing that, they reduce the total number of shares out there. So when you calculate earnings per share, the company's profit divided by the number of shares that EPS number goes up, even if their total profit stays the same, it's because each share now represents a bigger piece of the pie, so to speak.
Okay, that makes sense. It's a way to potentially boost the value of the remaining shares.
Exactly. And it's a strategy that companies with strong cash flow often use to try and, reward their shareholders.
Now, it is interesting to see the difference between the adjusted figures we've been talking about and the statutory ones.
Yeah.
Statutory operating profit actually went down, and so did statutory diluted EPS. What explains that?
Right. Well, the main reason for that difference is something called adjusting items. These are specific things, often one-off or unusual events, that the company chooses to exclude when they're calculating their adjusted figures. They do this to provide what they consider to be a clearer picture of their underlying business performance, stripping out the noise, so to speak.
Okay, so paint a clearer picture of the core business.
Right. And in Tesco's case, the statutory operating profit decrease of 3.9% and the diluted EPS decrease of 5.7%, those were mainly due to a big $286 million non-cash impairment charge.
Okay, now that sounds complicated. Break it down for us.
It's not as scary as it sounds. Basically, because of changes in the wider economy, especially rising interest rates, the value Tesco expects to get from some of its assets in the future is now estimated to be lower.
Oh, so it's a paper loss, essentially.
Exactly. They haven't actually lost any cash yet. But accounting rules, they got to follow the rules. And those rules say they need to reflect this change in how they report their profits. So their underlying business is doing well, as we can see from those adjusted figures. But this accounting adjustment has dragged down their official statutory profits.
Okay, that makes sense. Important to distinguish between the two. And we talked about free cash flow earlier. That came in strong, right? Toward
Right.
the top end of their own expectation.
Exactly. 1,750 million free cash flow. It's a good result. It shows they're generating cash from their operations even after investing in the business. It's actually a bit lower than last year, but that's because last year they had a temporary boost from something technical called trade payables. So this year's figure still represents really solid underlying performance in terms of cash generation.
And that strong free cash flow, I imagine, played a key role in their ability to reduce their net debt.
You bet. That 230 million reduction in net debt down to that 9,454 million figure was largely thanks to that healthy free cash flow. They also got 614 million from selling their banking operations, which also helped to pay down debt, even after accounting for, the money they've returned to shareholders through dividends and that share buyback program.
Last question on this financial stuff, I promise. They mentioned a return on capital employed of 14.6%. For the non-financial folks out there, what does that tell us about how Tesco's doing?
Okay, so return on capital employed, ROCE, it's a way to measure how effectively a company is using the money it's invested its capital to generate profit. A ROCE of 14.6%, that suggests Tesco is doing a pretty decent job. It's a good indicator of how efficiently and profitably they're running the show.
Okay, so financially, things are looking pretty good. But let's shift gears now and talk about their customers and the markets they operate in. It sounds like Tesco is actively putting money into initiatives that are all about, keeping customers happy and growing their market share.
Oh, absolutely. They're very clear about that in the report. They say their ongoing investments are all about improving customer satisfaction and driving growth in their market share. And it's not just about holding on to their current customers. They're trying to attract new ones, too.
And they gave us some specific examples of these customer-focused initiatives, didn't they?
They did. Things like their Fruit and Veg for Schools program. They've provided over 5 million portions of produce through that. It's a good way to give back to the community, but it also probably helps their image with families, right?
Right, makes sense.
And they also highlighted the progress they've made on their climate change targets. They've achieved a pretty significant 65% reduction in their Scope 1 and 2 emissions compared to their 2015-16 baseline.
Which, in today's world, that kind of commitment to sustainability matters to a lot of people.
Definitely. It's a factor for a lot of shoppers. Now, when it comes to keeping customers happy and engaged, we've got to talk about Club Card.
Ah, yes, the loyalty program. Seems like it's more than just a loyalty scheme for Tesco, though. It's a core part of their strategy, wouldn't you say?
You're absolutely right. It's woven into everything they do. They reported an increase in Club Card sales penetration across all their markets. In the UK, it's a whopping 84%. That's a lot of people using Club Card. Their Tesco app user base has also grown by 12% over the past year. It's now at 18 million users.
Hmm.
And the proportion of digital Club Card scans in the UK has shot up to 63% of all Club Card transactions. So yeah, they're really pushing the digital side of things.
And they're using all that Club Card data to offer more personalized deals, aren't they? Those targeted offers that tempt you with exactly what you might be looking for.
Exactly. They've rolled out Club Card challenges to 10 million customers. That's where they give you personalized goals and rewards. And they're also trialing something called your Club Card prices, which sounds like they're moving towards even more individualized pricing based on your shopping habits.
So the more you use it, the more they kind of tailor it to you.
Yeah, exactly. It's all about leveraging data to make those offers more relevant to each individual shopper. And it seems to be working for them.
Now, another area they seem to be putting a lot of effort into is their Tesco Media and Insight platform. For folks who might not be familiar, can you explain what that is and why it's becoming such a big deal for retailers?
Sure. It's essentially Tesco's in-house advertising and data insights business. So they have over 5,000 digital screens in their stores, and those screens can display advertising.
Oh, like those screens you see at the checkout lanes and stuff?
Yeah, exactly. They've also got video advertising on their website and app, and they're wrapping the outsides of their stores with ads too.
Mm.
And they've made the platform more accessible for brands and advertising agencies to use directly.
So it's a way for them to generate additional revenue beyond just selling groceries.
Exactly. They're essentially selling access to their massive customer base. And the insight part comes from all the data they're gathering on shopping habits.
Hmm?
They can then offer that data to brands, which helps those brands target their advertising more effectively.
So it's a win-win in a way.
Yeah, that's the idea. And for those of us who are all about speed and convenience, they're continuing to expand their Tesco Whoosh rapid delivery service too.
Okay, yeah, whoosh. That seems to be popular. How's that rollout going?
Well, it's now in over 1,500 stores. That includes 42 of their larger supermarkets. They've seen a pretty significant 48% year-on-year increase in active customers using Whoosh. And the average basket size for Whoosh orders is growing too. So yeah, it seems like there's a strong and growing demand for those quick, convenient delivery options.
The launch of Tesco Marketplace is also interesting. It's like they're turning their website into a one-stop shop for all sorts of stuff, not just groceries. What's the strategy there?
It's a smart move. By launching Tesco Marketplace, they're now offering over 400,000 products from third-party sellers, stuff like homeware, furniture, electronics. And the key here is it's a relatively low-cost way for them to greatly expand their product range online. They don't have to buy and store all that inventory themselves. They act as the platform and take a cut of each sale.
So it's kind of like what Amazon does?
Yeah, very similar model. They even mentioned plans to launch their own F&F clothing line online through the marketplace.
So they're using it for their own products as well as third-party ones.
Exactly. It's all about maximizing that platform.
And all these efforts, along with their profitability, are enabling them to continue returning cash to their shareholders through that share buyback program we talked about.
Yeah, they've been pretty active on that front. They see it as a key way to deliver value to their shareholders. Since October 2021, they've bought back a total of £2.8 billion worth of their own shares. That includes $1 billion they completed just this past April. And they've just announced another buyback program, a big one, worth £1,450 million. They expect to wrap that up by April 2026. That's going to be funded partly by their ongoing free cash flow and partly by the cash they got from selling their banking operations.
Okay, so lots of activity there. Looking ahead to their next fiscal year, FY 25-26, what are they saying? What should people be paying attention to? Well, they're forecasting their group-adjusted operating profit to be in the range of 2.7 billion to 3.0 billion. It's a slightly wider range than last year. And they expect their free cash flow to be somewhere between 1.4 billion and 1.8 billion. That's in line with their medium-term target. Importantly, they're acknowledging the increasingly competitive environment in the UK, and they're really emphasizing their focus on providing value to customers. So that wider profit range probably gives them some some wiggle room to adapt as needed.
Makes sense. Flexibility is key in a competitive market. Now, let's talk about those 4 strategic priorities they have outlined. First up is magnetic value for customers. What are the key ways they're working towards that?
Okay, so magnetic value, it's about making Tesco the obvious choice for shoppers by offering the best combination of price and quality.
The sweet spot, so to speak.
Right. A big part of that is price matching. They're benchmarking themselves against discounters like Aldi with their Aldi price match. That now covers over 600 everyday products.
So they're going head-to-head on price. Yeah, and they have their low everyday prices on over 1,000 products. Plus, their Club Card prices offer about 8,000 deals each week. They claim the most loyal Club Card members can save up to $392 a year with those deals. They're also extending exclusive Club Card deals to their Tesco mobile service and their insurance offerings. So it's not just about groceries anymore. And on top of all that, they're focusing on innovating their own brand products. They've got new lines like Taste Discoveries, their high-protein range, and their Gut Sense products, which are all about, health and wellness.
It's interesting to see how they're trying to cater to these, evolving consumer trends.
Absolutely.
Yeah.
They've also done some things specifically for Booker. They've implemented a price lock on certain items. And in Central Europe, they're expanding their low price guarantee. So
Right.
yeah, they're really trying to be seen as the place to go for value across the board.
Second strategic priority, I love my Tesco Club Card. It really does sound like they see Club Card as a differentiator, something that sets them apart. What are they doing to build on that?
Yeah, they're definitely doubling down on Club Card. It's celebrating its 30th anniversary this year, been around a long time, and they have over 23 million member households in the UK alone. To keep people engaged, they're running new campaigns, like offering bonus Club Card points if you use vouchers for EasyJet holidays. They're also expanding their network of reward partners. They recently added Virgin Red and a bunch of new visitor attractions. And get this, you can even earn points when you buy a new Vauxhall car.
Wow, so they're branching out in some interesting directions.
They are. And of course, that Tesco Media and Insight platform we talked about is closely tied to Clubcard. They're using that data to create more targeted advertising opportunities for brands. They see Clubcard as a huge advantage, one that helps them understand their customers and offer more relevant rewards.
Okay, on to priority number 3, easily the most convenient. Convenience is king these days, right? What's Tesco doing on that front?
Well, they're expanding their physical store footprint. They opened 90 new stores across the group, including 64 in the UK.
So they're still investing in bricks and mortar.
Yeah, but they're also refreshing their existing stores. 463 store refreshes. A lot of those were in the UK. And their online business is a big focus, of course. UK online sales grew by over 10%.
So they're attacking on multiple fronts.
Exactly. And they're seeing higher satisfaction levels among their online customers, too. Their Delivery Saver program is also growing. And for Booker, they added 566 new retail partners, which is a significant expansion of their reach in that wholesale market. They're also integrating Venus Wine and Spirit merchants, which they acquired recently. That's going to improve their offering for catering customers.
Last but not least, their Save to Invest program. This is all about efficiency, right? Finding ways to streamline and ultimately save money. What progress have they made there, and what are their plans for the future?
Yeah, Save to Invest is all about squeezing more value out of every pound they spend. In the past year, they achieved about £510 million in savings. They found efficiencies in things like goods and services not for resale, their store operations, property management, and central overheads. They're using new tech, like robotic automation in their distribution centers, and they're streamlining their stock flow processes.
So it's a wide-ranging effort.
Absolutely. And they're not stopping there. They're aiming for another $500 million in savings in FY 25-26. A lot of those savings will be used to offset rising costs, including a $235 million increase they expect in national insurance contributions. This focus on efficiency is key for them to be able to invest in other things, like providing better value to customers.
Okay, let's zoom in on each of their business segments now, starting with the UK. Sounds like it was a really good year for them on their home turf.
Yeah, the UK was a bright spot for them. Like-for-like sales grew by a healthy 4.0%,
Oh.
and they actually sold more than they had predicted. They're also taking market share from their competitors. They saw a 0.67 percentage point increase, bringing them up to 28.3% market share. That's their highest level since 2016. And their brand perception is improving too. People are seeing them as a better value, higher quality option.
So they're moving in the right direction.
They are. Food like-for-like sales were up 4.9%, driven by their new product launches. And remember that Finest range, the premium stuff, that saw that impressive 15% growth we talked about. Their clothing line, FF, is also doing well, 3.0% growth in women's wear. Now, their home category saw a slight overall decline, but if you take out the impact of their partnership transition with the entertainer, their sales actually grew by 3.3%, mostly thanks to the launch of their new F&F home range. So there's a lot to be positive about in the UK.
And online continues to be a big part of the story for them, right? Especially in the UK.
Definitely. Online sales grew by 10.2%. And Tesco Whoosh, their rapid delivery service, contributed about 3 percentage points to that growth. They're getting more orders each week, and they're seeing higher customer satisfaction online. Whoosh sales almost doubled, and people are generally happy with the service and spending more per order. And of course, the launch of Tesco Marketplace with its massive range of products, that's a key part of their online strategy as well.
What about the Republic of Ireland? How did they do over there?
ROI also had a good year. Like-for-like sales up 4.6%, driven by stronger sales volumes. Their Fresh First program, that's where they're revamping their fresh food offering in stores, seems to be resonating well with customers. And they're doing well in terms of product quality and innovation, too. They won a bunch of awards at the Blasnerian Irish Food Awards.
So they're making a name for themselves in the Irish market.
Yeah, they are. Total sales and ROI grew by 5.6% at constant exchange rates. Part of that growth came from new stores they've opened, which contributed about 1 percentage point.
Okay, let's move on to Booker, their wholesale division. We talked about that slight overall decline earlier. What can you tell us about the specifics of their retail and catering segments?
Right, so overall, like-for-like sales for Booker were down 1.8%. That's mostly because of the declining tobacco market and some weakness in the fast food sector, which impacts their best food logistics business. But their core retail business actually saw a 0.9% increase in like-for-like sales. They're growing faster than the overall market and adding lots of new retail partners. And their catering business is also growing like-for-like sales up 2.1%, driven by those price lock campaigns they've been running. They've also seen improvements in customer satisfaction and product availability. Plus, they're integrating Venus Wine and Spirit merchants, which they acquired recently. So yeah, despite the overall decline, there are pockets of growth and positive momentum within Booker.
And last but not least, Central Europe. We saw that strong profit growth earlier, but tell us about their sales performance there.
Central Europe delivered a 2.2% increase in like-for-like sales. That growth was driven by selling more and by an improved mix of products sold. They're gaining market share in the region, too. Food like-for-like sales were up 2.4%, with a particularly strong performance in fresh food. Customer satisfaction is up, and they're getting good feedback on their low price guarantee and their premium finest range. Non-food sales saw a more modest increase of 0.6%, but they had a really good Christmas trading period. So overall, it's a positive story in Central Europe.
Let's switch gears now and talk about their discontinued operations, specifically the sale of their banking business to Barclays, which happened during this fiscal year. What are the key points to understand about that?
Right. So that deal was finalized in November 2024. They sold their personal loans, credit cards, and customer deposit business to Barclays. They got 614 million pounds from that sale. Actually, they realized 700 million in total, and they've said they're planning to return that to shareholders through share buybacks. The financial performance of the banking operations is now reported separately, so it doesn't impact Tesco's main performance numbers. The banking business made a profit after tax of 26 million pounds, but that includes some accounting adjustments related to the sale itself.
Tesco also reported a number of adjusting items that affected their overall operating profit. Can you break down the main parts of those adjustments for us?
Sure. In total, those adjusting items resulted in a charge of 417 million pounds. The biggest one was that 286 million non-cash impairment charge. Remember we talked about that earlier. It's related to how they value their assets and is mainly due to those higher discount rates we discussed. They also had a 76 million charge for the amortization of intangible assets. That's basically the gradual write-down of assets they acquired in previous mergers, mostly related to the Booker deal. And they had a 43 million charge for restructuring costs related to their Save to Invest program. Interestingly, they also had a small gain of 2 million pounds from property transactions, but that was offset by a net charge of 14 million for other miscellaneous items. Okay, thanks for explaining that. Capital expenditure, that's the money they're investing in things like equipment and technology that was up this year, wasn't it? What were they spending that money on? Yeah, their total capital expenditure was 1,457 million, up from 12,218 million last year. They invested heavily in their digital platforms to improve their online operations. They also put money into automating their distribution network to make it more efficient, and they continue to refresh their UK stores to make them nicer for shoppers. They expect to spend a similar amount in the current fiscal year, so those remain key areas of focus.
Last but not least, the dividend. Shareholders will be happy to see that it's gone up.
Indeed, the total dividend for the year is 13.7 hour pence per share. The final dividend they're proposing is 9.45 pence per share. That represents a 13.2% increase from last year. And it's in line with their policy of aiming to pay out around 50% of their adjusted earnings per share to shareholders.
So, as we wrap up this deep dive, what are the most important takeaways for our listeners about Tesco's preliminary results for FY 24-25?
Well, the big picture is Tesco's doing well. They've grown their sales and their underlying profitability. They have a clear strategy that's focused on offering good value to customers, investing in key areas like online and convenience, and managing their costs effectively. They also got a nice cash injection from selling their banking business, and they're using that to reward shareholders through buybacks. The UK market is competitive, but Tesco seems to be in a good position to keep this momentum going.
Was there anything that stood out to you as particularly interesting or maybe even a bit surprising in these results?
You know, the growth of Tesco Marketplace is really something. The fact that they now offer over 400,000 third-party products online, that's a huge expansion of their online business. And they're doing it in a way that doesn't require them to invest a ton of money in inventory. It's a really smart move in the world of e-commerce.
And just to remind everyone, what's their outlook for the next year?
They're being a little cautious, which makes sense given the competitive landscape,
Yeah.
but they seem confident about their business and their ability to deliver value to customers.
So here's a final thought for everyone to ponder. Tesco's becoming increasingly digital. They're using Club Card to offer personalized deals, and they're expanding into